I think it's time to to start. I would like to welcome everyone. We resume our seminar series of the Center for Institutional Studies at the HSC University for the spring semester, and we are extremely fortunate to have as our first speaker this term Constantine Yannelis from Booth Business School at Chicago University, where he is a finance professor. Constantine does household and public finance, human capital. Last but not least, student loans, and his today's paper is on student loans. His BA is from University of Illinois, master's in math from Sorbonne, PhD from Stanford, and prior to joining Chicago, he was a faculty member of NYU, spent time at the US Department of Treasury, OECD, and the United Nations. As he mentioned before, he writes regularly to various periodicals. But first and foremost, we're interested in his scholarly output. So measuring the welfare effects of adverse selection in consumer credit markets. That's the paper, Constantine, because we had something else announced. Yes. There is a change? Okay. Yeah. All right, please, the floor is yours, and 45 minutes, and then Q&A. Thanks.
Great, thanks. Thanks very much. So I'm going to be presenting measuring the welfare effects of adverse selection in consumer credit markets. This is joint work with Anthony DeFusco at Northwestern Kellogg School of Business and Huan Tang at the London School of Economics. And as a starting point for this presentation, I want to direct your attention to the fact that adverse selection is known in theory to have important effects on the functioning and efficiency of credit markets. This has been known since Stiglitz-Weiss, if not before. And there's a very large empirical literature documenting the presence of adverse selection in consumer credit markets. So for example, this has been done in mortgages, auto loans, most consumer lending markets. And in this paper, what we want to do is go beyond simply testing for the presence of adverse selection and information asymmetries. But what we want to do is link theory and empirics to measure the welfare costs of adverse selection. And basically, if I just summarize this paper in one or two sentences, what we're trying to do is recover simple Econ 101 triangles from the data and provide a framework to do that. And we're going to do that in a particular setting. We're going to estimate the welfare loss from adverse selection in using data from a Chinese fintech platform that provides small consumer loans. And there are a number of reasons we focus on this market. One, it was a large and growing market globally. It's also a very new market. So if there were large welfare costs of adverse selection, we would expect them to be in this market or a market like this. But most importantly, for our setting, this lender conducted a experiment, so we have close to ideal variation in interest rates, which is going to be key for applying our methodology. But I want to stress that the approach that we're going to be using is quite general and can be applied to any consumer credit market, perhaps with some slight modifications, depending on the institutional details. So I'll just outline how we're going to recover the welfare costs of adverse selection. And basically what we're going to do is we're going to adapt methodology from the insurance literature to credit market. So basically what we need to do is estimate three curves: a demand curve, an average cost curve, and the marginal cost curve. So adverse selection will increase lenders' marginal costs and increase interest rates. And what we can do is estimate those three curves, and we can use that to compute the area of the triangle, which will give us the welfare loss of adverse selection. So this key insight comes from the insurance literature, in particular, Ina, Finkelstein, and Cullen. And basically, these three curves, demand, average cost, and marginal cost curves, are sufficient statistics for welfare analysis. So once we come up with a formula linking these three curves to welfare, we can estimate them using a random experiment. And basically, what you need is data on take up of loans, data on costs, defaults, or charge-offs, and a key thing is you need variation in prices or interest rates. And we're going to get that using this experiment that was conducted by a Chinese fintech application. There were about 11,000 random loan applicants, and they were divided into two groups: a control group that was offered the standard terms, and a treatment group which was offered an approximately 40% reduction in borrowing costs. And we're going to use this experiment to trace out demand and cost curves and how they vary with interest rates. So from the experiment, we're going to find that the market is adversely selected. We'll find that increasing interest rates by approximately 10 percentage points leads to a decrease in the loan take up of about 4.3 percentage points. That's a downward sloping demand curve. We'll find that the increase in interest rates of 10 percentage points increases the charge-off rate by about 1 percentage point. That's the upward sloping average cost curve. So that in and of itself is evidence of adverse selection. I mean, that's kind of what a lot of the previous literature has been doing. Now, despite the fact that we find the presence of adverse selection, we find very small overall welfare losses of adverse selection, which was surprising, at least to me, and I think to all the co-authors. So we found that the equilibrium interest rate is about 30%, and the efficient interest rate, where the demand curve would intersect the marginal cost curve, would be about 9%. So there's quite a large price distortion in equilibrium, but despite this large price distortion, welfare losses are very small. They're only about, they're less than 1% of the loan amount, or about $7.20 per applicant. And we find that this small welfare loss is largely driven by inelastic demand. We do some heterogeneity as well and find that the welfare losses are about twice as large among borrowers with low initial credit scores. Okay, so here's an outline of where I'll go with a talk. First, I'll talk about the empirical setting, experimental design, and data. Then I'm going to go into the conceptual framework, estimation, and results, and then I'll wrap up. So as I mentioned earlier, the lender that we work with, we're not allowed to say who the lender is, but it's an online fintech consumer lending market. Basically, this is an app that makes small loans. So you can think of this as, I don't know what the equivalent would be in Russia, but it would be similar to something like Avant in the US. Basically, people use their phones or their computers, and they provide information and get small loans. So the typical loan size is just under $1,000. These are also short-term loans. The typical maturity is about 1 year. And these are high borrowing costs. The typical interest rate is about 36% in the data. So, well, these are not quite as high borrowing costs as, say, payday loans. I mean, it's in that direction. So these are typically borrowers who can't access other cheaper forms of credit. So in terms of the fees, there are a couple of different components of the charges that lenders make to consumers. So first, there's a base interest rate that investors pay over the full loan term. There's also a quality assurance fee, which goes to the investor over the full loan term, an origination fee, which is paid during the first 3 months. And when the borrower is making the decision to borrow, they see basically the sum of these fees and a payment schedule. So we can think of the sum of these fees as the price. So in terms of the experiment that the platform ran, they were very interested in recovering, in particular, demand curves. So what they did was they randomly selected 11,000 applicants in early 2018, and all of these had qualified for credit. So that's the stage that we're looking at. Borrowers had applied and they had qualified for credit, but they hadn't been given a price yet. So the control group was offered standard financing terms with an interest rate of 36%, whereas the low price group, the treatment group, was offered a 50% reduction in two components of the pricing, which means they were paying an effective interest rate of 21.5%, so much lower. This is the variation that we're going to use. Before I get to results, I just want to show you some covariate balance tests. I mean, it's always a concern when an experiment is being done, particularly by a company, that there's a problem with a randomization. What this figure is showing is various characteristics from the treatment and control group: age, sex, marital status, education, city tier, credit rating. And what you can see is that they're almost identical. The borrowers are mostly men, but both for the treatment and control. They're predominantly younger, given this is a fintech platform, and so on. And the key thing is that there aren't differences between the treatment and control group, which makes sense because people were randomly put into each group. Now, where we do see differences is the take-up rate and the charge-off rate. I think there was a question. Great. No question. Great. Maybe Bernardo, if there's any questions, you can just read them.
Yes, I will do that. So I guess focus on your presentation, Constantine. I will let you know any questions.
Okay, good. And feel free to interrupt me. I like being interrupted, so just feel free anytime.
Okay, cheers.
I'm very bad at multitasking, so I cannot read the chat if I'm thinking about what to say. Great. So here's the take-up rate and the charge-off rate, and there we do see significant differences. You can see individuals, given the low price, are more likely to take up the loan. This is just a standard downward sloping demand curve. More interestingly, perhaps, is that we see individuals given the low price are less likely to charge off their loan, and this means that there's an upward sloping average cost curve or evidence of adverse selection. So what we're going to do is we're going to use this information here from the experiment to go beyond simply this evidence of adverse selection, and we're going to try and quantify the welfare losses arising from adverse selection. So now,
Constantine, if I may, people might appreciate if you explain charge-off meaning. That's technical term.
Sorry, this is you can think of this as defaults. So this is
writing off, right? Write-off.
Yeah, exactly. Write-off. So this is the portion of the principal that the lender doesn't recover.
I see. Okay, good. Thanks.
Perfect. Okay, so now I'll go into the conceptual framework. We assume that they're one-period loans, a fixed loan size. There's more than 2 lenders that are identical and risk neutral that choose some interest rate. They're heterogeneous borrowers that are endowed with characteristics, and they accept or reject loan offers at a posted rate. So right now, we're assuming that borrowers are risk neutral because the acquisition is much easier. We're working on the risk averse case, but we haven't finished that yet. So borrowers have some utility of accepting the loan, some outside option, and this parameter rho defines the maximum acceptable rate at which borrowers will take the loan, and that defines a market demand curve. The expected profits of the lender are very standard. They're given some interest rate, a fraction of borrowers default, and then there's some recovery. Theta is the charge-off rate of those dollars in default, what gets written off. And then there's also some fixed costs, which we can think of as a cost of funds, or also including customer acquisition costs. So the average cost curve is given by the following expression, where we're going to use this notation. We're going to call C of X is equal to the cost of funds plus the cost of charge-off. And the charge-off costs we're going to estimate in the data. The customer acquisition costs we're going to calibrate based off of numbers given to us by the lender. And the marginal cost curve is given by the following expression. Okay, so in equilibrium, the interest rate is equal to what we'll call the modified average cost curve, right? Equilibrium will occur where the demand curve intersects the average cost curve, which will define the equilibrium price and quantity. And as I just said, so here where the demand curve intersects the modified average cost curve, right? That just defines the equilibrium price and quantity. In terms of welfare and efficiency, consumer surplus is given by the following expression. We assume that there's some money metric value of taking the loan and a money metric value of not taking the loan. And the consumer surplus will be given by in the case that the borrower takes the loan, the difference between the money metric value of taking the loan and what they end up paying. And in the case if they don't take the loan, the utility is just given by the money metric value of not taking the loan, and the total consumer surplus is going to just be the integral of those over all of the borrowers who take up the loans or don't take the loan. And as I mentioned, right now we're assuming risk neutrality. We probably will in presentations going forward because the expressions are much easier to work with, but we're adding a risk averse case, which is likely more realistic. So producer surplus is given by the following expression. Again, just what they get paid, the price minus their costs. Total surplus is given by the sum of consumer and producer surplus, and in the efficient allocation, a borrower receives a loan if and only if the value of taking the loan, the difference of the money metrics, is greater than the cost of the loan. In our context, we assume that the lender doesn't observe the heterogeneity of the borrowers, so we have a constrained efficient allocation where the borrower only receives the loan if this expression holds in expectation. And so we can rearrange this a bit, and what we get is that the price is greater than what I'll call a modified marginal cost curve, and the efficient allocation occurs where the demand and modified marginal cost curve intersect. Okay, so we have three curves: a demand curve, an average cost curve, and a marginal cost curve. And if we remember from our Econ 101, this will give us a deadweight loss triangle, like a very standard Harberger deadweight loss triangle. So I mean, the key insight here is that if we have these three curves, the demand curve, the modified marginal cost curve, and the modified average cost curve, we can just compute the area of that triangle, and the associated deadweight loss stemming from adverse selection. We'll also have the equilibrium price and quantity given by A, and the implied efficient price and quantity at B. So what I'm going to do next is tell you how we use the experiment to come up with those three curves and the triangle and the empirical analog. But I want to stress that the methodology could be used in a lot of other settings. All you need is data on loan take-up, charge-off or defaults, and some variation in prices. I mean, maybe we'd want small modifications for institutional details in other credit markets, but this is broadly applicable. So we want to estimate a demand curve and an average cost curve first. So what we do is we regress loan take-up on price and charge-offs on price to get those two curves. Here, what we do, because we have the experiment, we instrument for the interest rate using assignment to the treatment and control groups. And then we can use this expression for the marginal cost curve to come up with a formula for the marginal cost curve using the parameters that we estimate from these two regressions. So that's how we're going to get our three curves. So the equilibrium allocation is going to be given by the following expressions. It's a fairly complex formula of the parameters we estimate in the two regressions. I'm not going to put those on the slides, but they're in the paper. And the welfare loss is just given by the area of that triangle that I showed you earlier. I'm going to show you the graphical analog of the figure that I showed earlier in a moment. This one, but that deadweight loss, that's just the area of this triangle. So here are the main results. So here's the experiment results that I began with. That there's evidence of adverse selection, and we're going to use these to get those curves that I just showed you. So we'll start with the demand curve. It's very simple. We just run an IV regression of loan take up on price, instrumenting for price with the treatment. Here are the results, right? So we get a negative coefficient. Demand curves slope down. At zero, if prices were zero, a lot of people, but not everybody, would take up the loan, which is interesting. It's an experiment, so if we put in demographic controls, geography, and loan size and rating, we get very similar coefficients. Again, all of the characteristics are randomized, so this should happen. We use this to get our demand curve. So here are the 2 points from the experiment for the treatment. Here's the treatment group, which has a low price, and the control group, which has the high price, right? This is the price that they're given, and this is the quantity that we observe being taken up. This is like the bar graphs that I showed you, or it comes from the regression. And we're using these 2 points to define a demand curve. We're doing an experiment here, but again, I want to stress that you could just estimate a demand curve in any other consumer loan market. Now let's turn to the cost curve. We just run our regression of charge-offs on prices. And here we find a positive coefficient. So there's an upward sloping average cost curve if prices go, which means that if prices go up, borrowers become more risky, which is evidence of adverse selection. We can do the same thing here, and this gives us an average cost curve. So here's the demand curve. Here's the average cost curve. The marginal cost curve is a little bit more complicated. We have to use the parameters from the regression, but we use the following expression: the fact that the derivative of the total cost curve is going with respect to demand is going to give us the marginal cost curve. So we get the following expression for marginal cost, which is just a function of these parameters that we estimate. So we can put that in, and then we have a modified marginal cost curve. So here's the analog to the 3 curves that I mentioned earlier in the simple kind of Econ 101 type figure. And here's the deadweight loss triangle. And this is all estimated from the data. So we've come up with an empirical analog to that simple kind of Econ 101 figure. And we can use this to get equilibrium prices and quantities, as well as efficient prices and quantities, as well as welfare losses, the areas of that triangle. And this is in the 4 specifications varying different controls. Again, things change very, very little because it's a random experiment, and the controls just don't matter because they're balanced across the treatment and control groups. But what we find is that there is adverse selection, and so there's a very large equilibrium price distortion. So in equilibrium, the price is about 30%, or the interest rate is about 30%, which is very close to what we actually see the lender charging. What we find is the efficient price is much lower. It's about 8.5%. So there's a very large equilibrium price distortion. However, demand is relatively inelastic. So we find quite a small equilibrium quantity distortion. So in the efficient price, quantity would go up only about 10 percentage points. So not a very large change. Now, the welfare loss is actually quite small. It's only about 0.8% of the loan amount, or about $7.20 per applicant. So I mean, this was at least surprising to me, and I think it was surprising to everybody involved in the project, that even in this market where you have small unsecured loans to relatively high risk borrowers, we find very small welfare costs of adverse selection. So I mean, there's a big debate about regulating this sector in China and many other places, and our results suggest at least that concerns about adverse selection are not a strong reason to regulate this to regulate this market. Now, I mean, there may be other behavioral concerns, but that's a separate story. So here, one point that I want to make too is that these points are showing the points from our experiment in the treatment and control group. So one thing that's nice about this setting is that the deadweight loss triangle that we're estimating, it's not that far from the area of our experiment, right? You could imagine that the equilibrium price and quantity was out here, and the efficient price and quantity is here. I mean, then it might be kind of a problem to extrapolate, but at least in our setting, the efficient price and quantity are kind of not that far from the equilibrium price and quantity. So it's a little bit, it's kind of nice in that regard, but that might not be true in other settings. So the last thing that I'm going to do before we move to discussion is I'm going to talk a little bit about heterogeneity in terms of the welfare costs of adverse selection. What we do is we split up borrowers by their estimated credit ratings. In China, they use these letter bins, and what we find is that demand doesn't vary much at all based on credit rating. So the demand curves are quite similar for low and high credit score borrowers. Cost curves do. So for the high credit score group, we don't find much evidence of adverse selection. Actually, there's no significant effect, although coefficients are positive. Whereas for the low credit score group, we do find a significant relationship between interest rates and average cost curves. And that when we translate that into welfare estimates, we find much larger estimates of the deadweight loss of adverse selection for the low credit score group relative to the high credit score group. So we haven't computed standard errors yet, but I mean, these may not even be significant for the high credit score group. It's my prior that they wouldn't be, given that for the high credit score group, the relationship between charge-offs and price is not significant. So the welfare losses are substantially larger for these borrowers who are observably riskier. Okay, so before we move to discussion, I'll just summarize the main results. So we find that this market is adversely selected. Increasing interest rates by 10 percentage points leads to a decrease in take-up rates of about 4.3 percentage points. So demand curves slope downwards, not surprising. We do find evidence of adverse selection. Increasing interest rates by 10 percentage points increases the charge-off rate by about 1 percentage point. And this means that borrowers who endogenously select into higher rates have higher expected costs, or there is adverse selection. So we use these relationships to estimate demand curves, average cost curves, and marginal cost curves. And this allows us to compute the equilibrium prices and quantities. The equilibrium occurs when the demand curve crosses the average cost curve, and the efficient pricing quantity occurs when the demand curve crosses the marginal cost curve. We find a large equilibrium price distortion. So the equilibrium interest rate is approximately 30%, whereas the efficient interest rate is only 9%. Now, despite these large price distortions, we find very small welfare costs of adverse selection, less than 1% of the overall loan amount, and this is driven by relatively inelastic demand. And finally, we find that welfare losses are larger among observably riskier borrowers. I mean, so I think these results are interesting in and of themselves. I mean, this is a large, growing, and important market, and there's a lot of controversy surrounding the fintech market, and our results suggest that there's not a lot of adverse, or let me put it this way: the welfare losses of adverse selection are very small in this market, so it's kind of hard to argue for government interventions like loan guarantees or interest rate subsidies. I mean, it's also hard to argue using concerns about adverse selection that there's a large role for regulating this market. But beyond simple fintechs, I think the main contribution of this paper is in terms of providing methodology and showing how methods from insurance can be adapted to consumer credit market. So our hope is that this methodology is going to be used more widely in the finance literature, because all we need is data on three things, right? We need a demand curve. So we need data on whether borrowers take up a loan. We need an average cost curve and a marginal cost curve. So we need data on who ends up repaying or charge-offs, and we need some variation in interest rates. So hopefully this methodology can be applied to a wide variety of consumer credit markets, because there are a lot of data sets out there that have loan take-up, defaults, and interest rates. So hopefully this is going to be used in other credit markets. And with that, I'll wrap up, and we can talk about, I can answer questions, and we can talk about anything.
Okay, thanks very much, Constantine. Well, the floor is open for Q&As, please. Any questions, any comments?
I have a quick question from the conclusions, actually. So you state that that you found like surprisingly small welfare losses. What was your prior expectation on this? Like, how much larger were these welfare losses compared to what you found?
Yeah, so I didn't have a specific prior for what it would be, other than just much larger. When they came out at under 1% of the total value of the loan, we were surprised. So, I mean, I don't think I had a specific prior. I mean, with the caveat, I should also mention that I don't know as much about this particular market, Chinese fintechs, but actually one of the reasons we ended up, we had the methodology first, and then we're thinking of kind of a good application to use. One of the reasons we kind of went with a Chinese fintech than other things we considered, I mean, the main reason is that there was this wonderful experiment available, but a secondary reason was we thought that there would be quite a lot of adverse selection relative to other credit markets, which turned out not to be the case, which I think is quite interesting. But at least personally, I didn't have a strong prior for what it would be, other than much bigger than under 1% of the volume of the loan.
Very good. Thanks. please. Other questions, other comments? Constantine, you said that your paper was inspired by similar papers for the insurance markets, right?
Yes.
And can you tell us what happens there? Is welfare loss of adverse selection there higher than in the case of credit?
Yeah, so I think the closest paper is Ina Finkelstein and Cullen, and their welfare losses are higher, but not tremendously high. And then I should also caveat that this is a one market that we've applied it to, and maybe welfare losses are much higher in other credit markets, but if not, then I think we do need to rethink a little bit about the theoretical justification for a lot of interventions in credit markets. Many of those are predicated under adverse selection problems being significant. At least in this market, it doesn't appear to be the case. I mean, it may be in other consumer credit markets. I mean, I should also add, in health insurance, it's kind of the same thing, that a lot of papers have shown evidence of adverse selection, but it's appearing more and more that the welfare consequences are relatively small. And one anecdotal piece of evidence of this comes from the Affordable Care Act in the US, or Obamacare, where the individual mandate was struck down by courts. Now, 10 years ago, there was great concern that the health insurance system could not function without forcing everybody to buy insurance because of these concerns of adverse selection, right? All the young, healthy people would not buy insurance, and that would push up premia and even lead to a death spiral and the collapse of insurance markets. Now, 4 years ago, the mandate was eliminated by courts, and we really haven't seen this death spiral come to pass. I mean, the markets are functioning just fine, which again is kind of suggesting that that at least these adverse selection concerns were not as large as was previously thought.
Yeah, well, here's a Chicago boy, right?
maybe.
Okay. Well, if I may, another quick question. You said that the welfare losses are modest because the supply curve is, or the demand curve is inelastic, sorry. So basically what we see is an increase of the interest rate, but not much of gross welfare losses. Is it possible that this is because you see quite a bit of a transfer of wealth from borrowers to lenders? And
Yeah.
if you calculate welfare losses for borrowers only, then the picture might be somewhat less benign. And, and in that case, you see more of a problem. And the development literature emphasizes access to finance. So adverse selection in that case is an obstacle to access. So what can you say about all of this?
Yeah, that's a very good point, and it's something we haven't explored in detail yet. But the fact that there is a big price distortion and small welfare costs does suggest that there's a big transfer from producers to consumers, and of course that can be very relevant to policy, because regulators probably care about consumers much more than they care.
So not from producers to consumers, from consumers to producers, right? Or,
yes. Sorry, I missed.
Yeah, right. No, that's fine. Yeah, sure.
From adverse selection, yeah, from the consumers to the producers. So that's something we should separate in the future. We haven't done it. We haven't done it yet, but that's I agree. That's given the results, that's almost certainly happening, and it's important from a policy perspective to measure the losses to each group.
Okay, thanks very much.
Thank you.
Please, other questions, any other comments?
Yes, I have one more like a question comment. Do you think that it would be possible to like somehow replicate this in maybe a lab experiment, like to see like how similar or different are the results from your paper? And I guess a lab experiment, like it takes less resources than like a large scale randomized controlled trial or something.
Yeah, I think it would. Yeah, it would be possible to do this in a lab experiment. I mean, I think you could do pretty much the exact same thing. Now, my concern with what a lab experiment would tell us kind of goes to like the Holt and Laurie paper, and it's been shown for risk aversion that the estimates you get from a lab experiment vary based on the size of the gamble. Basically, people are much, as you'd expect, people are much more risk averse when there's real money on the table, whereas if it's just a couple of dollars in a typical lab experiment. So my concern would be there would be a similar phenomenon here in that if there were small stakes, the estimates might be very different. One thing to stress too is that one doesn't necessarily need experimental variation in interest rates. If there's any type of, like in the insurance literature, I know of no paper that actually has an experiment. They use things like promotional offers of companies to people. So I mean, there's quite a lot of good variation in interest rates in the household finance literature, coming from lender pricing rules, regulatory cutoffs, so on and so forth. So I think what could be very promising is to use a lot of that variation to study the welfare costs of adverse selection in the mortgage market, auto lending, every other market under the sun. But I mean, to answer your question, yes, it could be done in a lab experiment, but I'm not. My guess is my prior would be that there would be similar results qualitatively, but I'm not sure how to interpret the quantitative estimates, given that the stakes would likely be so much smaller.
Okay. Anything else, please? Constantine, if I may, first of all, thanks very much for using your time so efficiently. So we have a little bit of time left. And second, there was a bit of a miscommunication, I'm afraid, in the announcement of your talk. It was announced that we were going to talk about student loan forgiveness.
Oh.
And what you presented is fine, and we appreciate this. But because we don't have the luxury of having you every day, and secondly, because there are quite a few people in this group who are doing analysis of higher education, and student loans were quite popular idea in Russia some time ago, not anymore, I guess. Maybe you can use a few minutes and tell us very briefly about that work of yours without going into details, just main findings. One thing which I found extremely intriguing is that student loan forgiveness is in fact a regressive measure. Never came to my mind, and if you think about this, that's quite natural. So maybe you can give us a sneak preview of that part of your work.
Absolutely. So I don't even have slides for that, but I can pull up.
We don't have time for full-blown presentation, but I hope people don't mind.
Well, sure. Yeah, I'll just talk about it, but I may pull up some things too.
Sure.
But,
thanks very much.
We'll
double our money.
Yeah, great. Yeah, as you mentioned, I mean, this has become an important policy topic in the U.S. So student loans today are the largest source of household debt outside of mortgages. There's 1.7 trillion in outstanding student debt, and of course, this has led to large concerns among policymakers. So one thing that has been proposed is forgiving student loans, and there have been a number of different proposals for student loan forgiveness, ranging from full debt discharge to forgiving a capped amount, say $10,000 or $50,000. So in my new paper with Sylvain Catherine at Wharton, what we do is we use survey data and try to estimate who would benefit from different loan forgiveness proposals. And what we find is that student loan forgiveness is a very regressive policy. And it's even more regressive when you properly account for the present value of the loan. I mean, so the basic reason why student loan forgiveness is regressive is because if you think about it, people who go to college earn more than people who don't go to college, and people who go to college for more years and go to more expensive colleges also earn more, right? Somebody who does a medical degree or a law degree, which in the US are graduate degrees, they spend much more on college than somebody who goes to does a 2-year trade type of a vocational degree. But those people who do these professional degrees, they also earn a lot of money over the life cycle. So that's the first reason why student loan forgiveness is regressive. The second reason why it's even more regressive is that if you account for forgiveness under the present system, then people towards the bottom of the income distribution are already expected to get very significant forgiveness, and that's through a program that already exists called income-driven repayment. And the way that these plans work is that rather than paying a fixed amount, borrowers pay a portion of their income. So there are a couple of plans, all with the same different features, but basically the way they work is borrowers pay 10 or 15% of their income above 150% of the poverty line, and then depending on the plan, after 20 or 25 years, the loans are forgiven. And so for people at the bottom of the income distribution, they're already going to get much more forgiveness under these and other plans. So what this is showing is average student debt in blue by deciles of the income distribution. You can see that it's not perfectly monotonic, but by and large, high income people have more student debt than low income people. Once you compute the present values of the loans, which are in red, for high income people, the present values are pretty similar to the balances, right? Because they're going to end up paying most of their loans. But for lower income people who are eligible for income-driven repayment plans, the present values are much lower because they're going to get forgiveness anyway. So the final part of our paper is, we kind of show that loan forgiveness is a very regressive policy. The benefits are going to go mainly to upper income people. Now, the natural question is, what is a more progressive policy to forgive debt for these people, the bottom of the income distribution? And it turns out that expanding income-driven repayment plans is much more progressive. So we consider a couple of different options for these income-driven repayment plans. So for example, one is you could increase the threshold above which you pay to 300% of the poverty line rather than 150% of the poverty line. And if you do that, you see, the upper income people end up getting very little of the forgiveness, whereas most of it goes to the lower middle class. Now, we experimented with various policies. It turns out you really can't do much get most of the benefits to go to the very poorest people. I mean, the reason for that is many of they just don't go to college. So student debt forgiveness is not going to be a policy that's going to benefit them much, unfortunately. But with the expansion of income-driven plans, what can be done is targeting most of the benefits to the middle class rather than the upper part of the income distribution. So any general questions about student loan forgiveness? I'm very happy to talk more about that, what we do.
Thanks. Are there any questions to Constantine about this part of his work? About student loan forgiveness? It's very interesting.
Well, I think more a comment than a question, but also like this is an issue that has been quite in the debate in Chile. And yeah, like now, like because like some years ago, like everyone had to pay tuition fees, and like, well, there were like some scholarships and loans, but most of the people had to pay for tuition fees. Now we are migrating to a system in which I think at the moment only like 50% of the, so like the 50% lower earning people, they don't have to pay tuition fees, but so far it has not narrowed too much the participation into higher education, because it seems that in the end it's not that much about being able or not to pay for your education, but like people from like lower income background, they go to like poor performing schools, and therefore they don't achieve the necessary marks to enter into higher education. And it seems that at least from your paper, it's kind of the same picture in the end. Like if like lower income people like still like won't have much access to higher education, regardless of tuition fees or student loan forgiveness.
No, I think that's definitely true in the United States as well. So I'll say kind of provide two examples, one anecdote and one from somebody else's research. That the anecdote is since the past 15 years, most of the very elite schools in the US have financial aid policies such that it's completely free for people people whose parents earn below very high thresholds. You know, at Harvard and Stanford, it's on the order of $150,000. So if your parents earn less than $150,000, it's completely free. I'm not sure what it is at Chicago, but I would imagine there's a similar threshold. Now, you know, it's a bit shocking in saying something about intergenerational mobility, is that there are actually very few students at these elite schools who end up taking these benefits because their parents are too high income. And it's not, to my knowledge, it's not an issue of selection in any way, because the admissions, at least the policy that they officially state, is that the admissions committee doesn't look at income at all when they're deciding to bring people in, but still few people from we're not even talking about poor backgrounds. We're talking about kind of non-rich backgrounds are getting in to very elite schools. So it's a similar problem in the US. And I mean, I think it's probably very similar to what you said in Chile. I mean, if you go to schools in many areas, I mean, they're just a disaster. I mean, for the public schools in the southern part of Chicago, I mean, the successful outcome to measure is staying out of jail, not going to college, unfortunately. In terms of, no, so that's at the very top of the education distribution. I mean, in terms of research, so some work that I found very interesting was this work by Hawksby and Turner about very high achievement students who end up not applying to college or not applying to elite colleges. And it turns out that many people are just unaware of these generous financial aid policies. So Hawksby and Turner had national data on test taking, and they basically looked for students who scored very highly on exams like the SAT, but didn't end up going to elite colleges. And it turned out that they were mostly in rural areas, and they went to high schools which didn't send very many people to very elite schools. And they ran an experiment providing information about financial aid, and it had large effects on application and enrollment. So a lot of people are just unaware, they see the sticker price for Harvard or Stanford, and they come from a farm I grew up in a rural area too, but they come from a farm or something and just think, it costs $80,000 a year to go to Harvard. There's no way my family can afford that, and they don't even bother applying. I mean, so information barriers likely play a big role to many people. And the same is probably true in student loans. So one problem now with income-driven repayment plans is many people who would benefit don't take up the plans. And I have another paper showing that kind of a very small intervention, just eliminating paperwork, has large effects on enrollment in these plans. We don't observe exactly what, the mechanism for why this treatment has a big effect on enrollment, but I would speculate that information has a large part to play. People may also not believe that these deals are real. So another anecdote about a research paper: I'm running an experiment in Latin America, in Colombia, with a company, and so we were offering better loan terms to people. And one plan is extremely generous. I mean, it's almost free. And we got the first data back a couple of weeks ago, and we were surprised. Only about half the people eligible took up the really generous plan. We talked to the company and asked them what's going on. People are leaving free money on the table, and they told us this was a pilot, so it's fairly small, but they told us a story. There was one person who wanted to take the plan, but they went to their co-signer, and the co-signer told them, no, this is a scam. There's no way that somebody would be giving you so good terms, so don't sign.
Well, being a Latin American, also, if I see a very cheap loan, also I would think that it's a scam. So I don't blame him.
Shall I say, being a Russian, so kind of too good to be true, right? Or free cheese is only in the mousetrap. Okay. Listen, thanks very much. I found it quite intriguing because forgiveness of student loans has an appeal of a very populist measure. And if you think a little bit deeper into this, you come to a very clear conclusion that this is actually something that would benefit the wealthy more than the poor. So be careful in this kind of.
That's true. Yeah, we'll see what happens now with the new administration. So before the election, they were very vocal about student loan forgiveness. As you said, it's a very populist measure. Now things have been much more quiet. And I think there are likely I'm speculating now, I don't have any inside information on their decision-making process, but my guess is that there are two things. One, their economists understand that this is regressive now. And two, there are also interesting legal aspects that make this difficult to do in the US because loan forgiveness is treated as taxable income.
Of course.
So if you have a lot of people who are not making payments because they're in IDR, making small payments, and then if you gave them a poll today and asked them would they like loan forgiveness, they would of course say yes. But if you actually give them loan forgiveness and then in a couple of months the IRS ask them to pay a big tax on that when they're not making payments, the political economy could change very quickly. So my guess is that their lawyers have told them that, and they're much more hesitant to do this.
Okay. Let me see if there are any further questions or comments about both of these projects, actually, dead weight loss of adverse selection and student loan forgiveness. And if there are none, all I have to do is to thank Constantine very much for opening up our eyes on a couple of very important issues. And Bernardo, if you can please remind us what's coming up next. connection.
Yeah, well, thanks again, Constantine, for your participation.
My pleasure.
Our next seminar is going to be in 2 weeks, so the 4th of February. And we will have a Cristiano Perugini from the University of Perugia, and he will be presenting his paper on credit and income mobility in Russia.
Excellent. Well, on that note, I would like to thank everyone for attending, and take care of yourself. We'll see each other in 2 weeks' time.
Okay.
Bye-bye. Thanks,
Bye.
Constantine.
Bye.